Welcome to the Purpose-Based Retirement with Certified Financial Planner Casey Weade. Casey is the president of Howard Bailey Financial.
Whatever risk you face during your retirement years, we've got a plan.
A published author and radio host.
It's not how much we make during the good times, it's how much we keep during those really bad times.
His advocacy for retirees and pre-retirees has made him a sought-after speaker and trusted financial leader.
And putting a real plan together.
This is the Purpose-Based Retirement.
Good to see you again. I am Lee Kelso here with Casey Weade, a certified financial planner and the president of Howard Bailey Financial. Our program today is all about income and risk. You're going to hear a financial term that may be new to you. Did you know you have an uncle point? Yes, indeed you do, and it's good to know what that might be. We'll explain that a little bit later on. First, we're going to start with the importance of structured income. Now, on a previous program, we touched on the point that most retirees want stable income in their lives, and that typically means a structured income plan. Casey, just exactly what do you mean about structured? What does that phrase mean when we're talking about income?
Well, there's two income strategies that people typically use once, even if you want to call them strategies, that they typically use once they get to retirement. One is you step into retirement and you say, well, I'm just going to pull 4 or 5% out of my portfolio every year. Maybe it's a 4% rule, and you increase that every year, say for inflation, and you don't really change the way you're investing. I see this time and time again with people that walk in with these big brokerage portfolios, and they're just taking income indiscriminately out of that portfolio, which means sometimes they have to sell some things to generate that income. And what happens is if the market goes down in value, then you end up violating the #1 rule of investments. You end up selling low, right? We're supposed to buy low and sell high. If you go back to a portfolio that was, say, worth $1 million in 2007, somebody's pulling $50,000 a year out every single year, and they say, hey, I've averaged 8% a year the last 10 years, everything should be fine. Then all of a sudden that $1 million portfolio turns into $500,000. Now we're pulling 10% out every year. Now we run the risk of running out of money during retirement. #2, probably most popular strategy that I so often see, is focusing on just living off the dividends, the yield, or the interest inside of that portfolio. Now, if we could rewind and go all the way back to 1975 and buy a treasury paying us 15% for the next 10 or 20 years, guaranteed, then that would be a fine strategy, right? We just don't live in that type of environment today. The dividend yield of the S&P 500 is around 2% a year. And just focusing on living on just the dividends can create a real problem called unpredictability during retirement. Let's say that you end up taking higher risk in order to generate a higher than a 2% yield on your bonds. Maybe you're taking on 10, 20-year terms in order to generate that interest, or you're buying higher risk, higher yield bonds, you're buying higher yield, higher risk stocks. Then what ends up happening when we have a 2008? In 2008, about 65 of the companies in the S&P 500 cut their dividend. That's the most at any other point in time in history. There was about $40 billion that were cut in dividends in the S&P 500. And during the first quarter of 2009, there were over $30 billion in dividend cuts. What that results in is a very unpredictable income stream. And what we talk about, Lee, when we talk about a structured income plan, is taking that portfolio and creating an income that you can not only understand, but you can feel and touch. You get to sit in our office and see. So often I'll hear, well, Casey, what's the market going to do this year? And I'll say, it doesn't matter, because regardless of what happens in the market, you've got a structured income plan that takes care of risk, takes care of taxes, takes care of inflation, and will be there regardless of how long you live. That's a structured income plan. There's structure.
Wouldn't that be nice to be able to sit there and have your advisor say, it doesn't matter what the market's going to do, you've got it covered. But how many people that you meet with actually are in that situation?
Yeah. Very few are actually in that situation. There's 3 categories, right? There's people that have a great plan, they've got a great income plan, they've got a middle-of-the-road plan, or they've got a horrible plan. And I've never seen anybody that walked into our office that had a great plan, right? Because even people that you might say the person that has a great plan, well, they don't need the income, because they've got pension and Social Security. They've got enough guaranteed income to satisfy all those needs. For instance, I've got a couple that I worked with, and they just stepped into, well, he's still working, and he has just stepped into retirement, and he's got a little anxiety, stepped away as an engineer here locally, and just, it's kind of stressful. But he's getting used to it. He's getting accustomed to waking up every morning and being able to sleep in if he needs to sleep in and not having a schedule. And as he stepped into retirement, they had a pension that amounted to about $70,000 a year. And then they also have Social Security on top of that. She's still working for a little bit longer. So their income plan's taken care of, right? Mm-hmm. You might look at them and say, well, that's a person that has a great income plan. But you know what they didn't have is they didn't fill in the gaps. They didn't take care of that tax strategy, that healthcare strategy, that legacy strategy. That's where we have to fill in the gaps. That's what I'd call somebody that's in the middle of the road. Then you have people that are completely on the other spectrum that don't have an income strategy, a healthcare strategy, a tax strategy, an emergency strategy, a legacy strategy. They haven't put all those different pieces together, and maybe you find yourself in that boat. It's okay if you're not 2 years out from retirement, but if you're in retirement and you haven't sat down and gotten these things taken care of, then it's time to get on the boat and not be a financial couch potato, as we so often say.
So how does your strategy differ from others that you've seen?
Yeah, well, I would say the main difference is it's comprehensive. You know, I see a lot of people that have maybe put together an income strategy. Maybe you had somebody walk into your house and they put this strategy together. It's going to give you a guaranteed income for the rest of your life. Or maybe you walked into your financial advisor's office and they said, okay, now we've got this income plan. Maybe you build a laddered bond portfolio or whatever it might be for your individual situation, but you haven't filled in the gaps at this point. So now you've got this guaranteed income maybe for the rest of your life. What if we have inflation? Do you have a plan for inflation? Have you set assets aside for that? What about rising taxes? What if taxes double over the next 10 or 20 years? And what if, God forbid, you end up with a major health care problem, you have a stroke, and now you're in a nursing home that costs $7,000 to $10,000 a month. If you don't have a plan for all those other things, then what's the point in having the income plan? Mm-hmm. Yeah, it's just one of a broader spectrum of things. When you step into retirement, you're doing something that you've never done before, and it's got to be a little scary. You know, it's like going into 20 or 30 years of unemployment. And can you figure out how you're going to withstand 30 years of being unemployed and all those different things that you've never thought about before? You've never thought about income. You've never thought about inflation. You've never thought about long-term care. You've never thought about all these things like you have to once you get to retirement. And that's why I say financial education at that point in your life has never been more important for you to know all of the options that you have so that you can sleep well at night.
We've got a little time here. Can you give me an example of a plan that maybe you put together for someone and how you allocated assets to meet all those needs?
Sure. You know, one person I can think of in particular, we had around $800,000 saved for retirement, and they both worked at the same place. You know, the couples, they had actually worked at the same company for years. They met there, worked there each over 30 years, and then retired with around $800,000. And they not only had 401k dollars, they had around $500,000 in their 401k, they had $300,000 in after-tax money at the same time. They needed to generate around $25,000 a year in income. Well, they were actually generating a lot of that income, and they had planned on taking it from that after-tax money, that $300,000. Well, they're 60 years old, and they're going to spend that after-tax money, then they're going to be left with this big old bucket of IRA money or 401k tax-deferred dollars. And then that RMD that they're going to have to take out, it's going to push them into a higher tax bracket and cause them to pay more in taxes once they get to be 70. And so instead, we put together a plan that guaranteed all their income with that IRA money, which is what IRA money is supposed to be used for anyway. And so we put together a plan that allowed them to take care of all their income needs with that portion, set aside $100,000 in order to take care of inflation protection, where we always knew we could get about a 20% increase in income should we ever actually need it. And then the remaining assets were set aside for health care and legacy.
So a structured income is what I think I'd like to have to sleep a little better at night when retirement comes. I know the first step to getting there is picking up the phone today. For the next 10 people who call us right now at 482-9559, it's an opportunity for a complimentary financial review of your entire retirement plan, an opportunity to get that education about your investments so you can make the best decisions for yourself, for your family, for your legacy going forward. So for the next 10 people who call right now, Casey and the team will make time on the calendar to sit down, visit with you, and give you your very own purpose-based retirement. Our question of the day, as of July 1st of this year, what was the risk-free rate of return? Was it a measly 0.27% or maybe as high as 6.27? We have the answer coming up.
Hi, I'm a certified financial planner practitioner. There is no silver bullet for your retirement, but that is what financial advisors are selling you every day. The fact is that in the constantly changing world we're in today, it's more complex than ever. But if you can establish a clear plan of action with well-defined goals, you've taken the first step. At Howard Bailey Financial, our goal is to lend you the confidence you are on the path towards the financial independence you deserve. If you'd like help designing your personalized retirement strategy, give us a call today.
You need a plan for retirement to create the lifestyle you've always dreamed of. The first step is to tune into the Purpose-Based Retirement Radio Hour with your hosts, Casey Weade and Marshall Johnson, every Saturday morning at 11 and Sunday afternoon at 1 on 1190 WOWO and 107.5 FM.
So heading into the break, we asked you the question of the day. As of July 1st of this year, what was the risk-free rate of return? We gave you several different choices. Casey, which one of those is correct?
Well, you might be surprised, or maybe not surprised if you purchased a CD recently, that the answer is A. The 3-month T-bill is generally considered to be the risk-free rate of return, and that's about 1/4% in today's interest rate environment. And a 1-year CD is on average paying 1.25% as of July of 2016, just 1.25% a year. And you may be stepping into retirement wondering, well, how am I going to be able to satisfy my needs during retirement in this type of low interest rate environment? Maybe your grandparents and parents before them, maybe they were using CDs and fixed annuities and government bonds to generate a good portion of the retirement income they were going to need. And now in this near zero interest rate environment, you say, well, how much risk am I going to need to take on? And we start having this discussion over risk tolerance. How much risk can I afford to take? How much risk am I comfortable to take? What's my capacity, my attitude, my need towards risk? Those are the types of questions that we start asking ourselves. You may have $1 million saved for retirement. You need $10,000 a year. Or you might have $300,000 saved for retirement and need $10,000 a year. Well, one person can probably thrive with a 1% CD, while the other one needs to take on risk. So what does that mean? And we're going to talk a little bit about that today.
And as you can see, joining us to do that is Marshall Johnson, Certified Financial Planner and Vice President at Howard Bailey Financial. What about that? When you ask people in the office about their risk tolerance, do they understand what that question really means?
I think that's a good topic, Casey, for this show. Risk tolerance means very different things to different people. Your idea of conservative and my idea of conservative may be two very different things. It's like going to a Chinese restaurant and saying you want something spicy. Well, your version of spicy might be a lot hotter than mine.
Especially a Thai diner.
Yeah, exactly.
Yeah, you say hot over there. You're kidding. So really understanding what that means for me, Lee, I tend to not ask that question because I feel like it's such a canned question, and so many people are either polarized. They're either, oh, I hate the stock market, or I'm a risk taker. So, and many people just say, well, you know, I'm somewhere in the middle. And that the reality is that it changes. You may want spicy food one day, but not the next day. Your tolerance for risk and what you're looking for can vary over time based upon who's in the White House, what's going on around the world. These things change on a very regular basis. So it's a difficult question.
So how does the average guy deal with that?
Well, I think that's something that we all need to take into consideration when we step into retirement and make sure that we're getting asked the right questions in the first place rather than just sitting down and filling out some risk tolerance questionnaire where it says, well, are you more comfortable with a 5% loss and a 10% gain, or a 50% loss and a 75% gain? I mean, those things are very convoluted, I would say.
Yeah, and it starts with having that discussion. And really, our attitudes and beliefs about money have been generated from the time we were 4, 5, 6 years old. Lee, what was money like growing up when you were a child? You're going to get a much different response when you start asking those sorts of value questions. You could go through some very difficult times that make you be very risk averse, but also Casey talked about risk capacity. You may need to take on more risk, and that's where we just have to have that conversation where someone understands that there's the financial ability to take risk, but there's also the mental ability to take risk, and they don't often go hand in hand.
You know, and to your point that everybody has a different idea of what conservative, moderate, and aggressive means, because that, I mean, most of the time it seems like we're making this assumption that every investor can be put into one of three boxes,
right,
whether conservative, moderate, or aggressive, and you can't. And I think that's what you're getting at. Everybody's individual, everybody's unique. I had a single lady that I started to work with here a few weeks ago, and we analyzed their portfolio. So we sit down with you, we get to know who you are, and when I got to know who she was a very conservative individual, self-described conservative investor. And then we got to our second meeting where we would analyze her risk, her individual performance over the last 15 years, how those things performed, the amount of standard deviation, all this stuff that we have to go through. But we focused on the risk because she said she never wanted to lose any money. And I said, well, what do you think conservative to moderate, what's that mean to you? And she said, well, she really had never been asked that question. Mm-hmm. She said, well, how much are you comfortable with your portfolio going down in value? And she said, I've seen it go down $30,000 to $50,000. Mm-hmm. And there was around $500,000 there. Mm-hmm. And I said, well, if we look at the extreme, this exact portfolio would have lost upwards of $150,000 during 2008. Are you comfortable with that type of risk? She said, no, I didn't realize I had that much risk. I thought I was more conservative.
Yeah, and Casey, the problem there is when we get into this big box corporate finance world, we have these questionnaires, and that questionnaire is designed around suitability.
Yeah, it's designed around the advisor, not the client.
It's designed around the firm to protect themselves, make sure they understand what is suitable for someone. So you've got questions about the financial ability and the mental ability that may bring somebody more aggressive than they need to be, or may bring somebody more conservative than they should be. So that's where we have to go with this.
I want to back up. You guys just said it's designed around suitability to protect the big firm.
Yeah. Well, as financial advisors, there's risk, right? You have risk that you're putting your client in a too aggressive a portfolio. So they're designing a questionnaire to help them report how aggressive or conservative you are, but it may not be getting to the root of the issue or getting you to the right goal.
And the types of questions that we're asking when we sit down with individuals is, I mean, every time I get through this list of questions, we get to the end of the meeting, I say, I've never had this types of conversation with a financial advisor. It's always been, look at this portfolio, this is made 5%, you only need to make 5% a year, or look at this annuity, look at this real estate investment trust. You know, it's never focused on the client, it's focused on some type of product and protecting the advisor with some suitability questionnaire.
So there's a lot to learn about risk, and we're going to get to that in just a second. Right now, I hope that if you're thinking about the risk that may be in your portfolio and you don't know about it, well, here's an opportunity to find out exactly what's going on there. For the next 10 callers who dial 482-9559, it's an opportunity to sit down and receive a complimentary financial review of your retirement plan and exactly what's going on in your life. You've heard the kind of questions that you'll be asked. Let's understand you and your needs and your tolerance for risk, and then Casey and the team at Howard Bailey will help put together that purpose-based retirement that's just for you. So 482-9559 is the number to call. And the next 10 to dial right now will be online to receive a complimentary financial review. We're back in just a second. Stay with us.
Hi, I'm a certified financial planner professional. I believe the bar for entry into the financial industry is far too low. You and your hard-earned money deserve better. With a CFP professional, you can have the confidence you are working with an advisor who has met not only rigorous education and experience requirements, but also is held to the highest ethical and professional standards in the industry, resulting in better methods that will address the financial challenges you will face in retirement. If you'd like to see how a CFP professional can serve you, give us a call.
You need a plan for retirement to create the lifestyle you've always dreamed of. The first step is to tune into the Purpose-Based Retirement Radio Hour with your hosts, Casey Weade and Marshall Johnson, every Saturday morning at 11 and Sunday afternoon at 1 on 1190 WOWO and 107.5 FM.
At the beginning of the program, I mentioned you're going to hear a phrase that's not commonly used in financial planning, and that is your uncle point. Casey's going to explain that to you as we continue our look at risk. Casey?
That's right, Lee, and we're going to do so using a mnemonic. Many people ask me, well, how much risk should I be taking at this point in my life? How much money should I have in the market? How much should I have in the stock market? And really, the right question should be, how much risk can you afford to take at this time in your life? Can you take the risk? And that comes down to three different things. One is the capacity to take the risk. Do you have the capacity to the risk? Can you afford to take the risk? Do you have the attitude for the risk? Or are you going to hit your uncle point a little early and end up violating the #1 rule of investments and selling when the market's low? And do you have the need for the risk? What we want to find is we need at least 2 out of these 3 things in order for you to take that level of risk. And that first thing is the capacity of risk. And that's really a function of 2 different things: investable assets and time. When it comes to your investable assets, put it this way: if you had $1 million saved for retirement and you needed $10,000 a year, you could put that $1 million in a 1% CD and never take on any risk. However, you have the capacity to take on the risk much more than someone that has $100,000 saved for retirement. Another factor is time. If you're 30 years old and you don't need that money for 30 years, then you have the time to go through the ups and downs of the market. The market's averaged 6 to 10% a year over the last 100 years. The 6% has been the 10-year rolling average, 10% has been the 30-year rolling average. What's that tell us that you need in order to be successful? You need time, because there's been 25-year periods, 12-year periods, 11-year periods, 15-year periods when the market's been flat or negative. And you have to be able to endure those negative time periods and not touch that portfolio. Then we can also institute the basic rule of 100. The basic rule of 100 says take your age, put a percentage behind it, and that's how much you should have in protected assets. If you're not going to implement a true financial plan, you're going to try to do it yourself or just work with a broker that's going to sell you some investment products, then use the rule of 100. If you're 60 years old, 60% should be in protected accounts, 40% at risk. We can also take a look at this risk capacity spectrum. If we have a high risk capacity, then that means we have a low required rate of return and there's low risk to that goal. For instance, again, we need $1 million and we need to generate $10,000 a year, low goal risk, low required rate of return, but a high capacity for risk. On the other end, if we have a low capacity for risk, we probably need a higher required rate of return, and we're looking at a higher or a highly risky goal, which means we either maybe potentially have to work longer or change our goals and our needs altogether. Now, once we've figured out our capacity, do we have the capacity for the risk or not, then we can have the attitude discussion. Do we have the attitude for the risk? What's our risk tolerance? Or in other words, what's your uncle point? At what point are you going to say, I need out, we need to go to cash? Because if everything's at risk in the market, we have to be able to endure those bad times and not panic. If you panic, that's how people run out of money during their retirement. Another way that we like to analyze if you have the attitude for the risk is take a look at a couple of different scenarios and see which one makes you more upset. The market's maybe up 20%, but you're only up 10%. Does that make you more upset than if the market's down 20% and you're down 20%? Because in order to make 20%, you might have the potential to lose 20%. So are you willing to give up a little growth potential in order to have some protection? What is your attitude for the risk? If we do that using some of those basic questions that we so often hear financial advisors ask, am I mainly concerned about losing money, or am I mainly worried about the potential rewards that can be created? So our attitude, if we take a look at that risk capacity spectrum and then we enter the risk tolerance, if our risk tolerance is over here but our goal is over here, then we might need to shift that goal further to the right, or we might also need to add more to our retirement portfolio, which might mean working a longer period of time. Now we have the capacity. Maybe we have the attitude. What about the need for the risk? Is the risk really necessary in the first place? I have a client that retired from Phoenix, Arizona and moved to Indiana. Already know he's a crazy guy, right? He's got $3 million saved for retirement. He needs to generate less than $30,000 a year in income. Most people would say that's somebody that can afford to take the risk. He said, Casey, I don't need to take the risk, so why would I? And he wanted everything protected. So we need to have at least 2 of these 3 things in order for you to take the risk. Do you have the capacity to take the risk, but maybe you don't have the attitude or the need? Then you shouldn't be taking the risk like the individual that I just spoke about. He didn't have the attitude, he didn't have the need, he only had the capacity, so he didn't want to take the risk. Maybe you have the attitude for the risk, but you don't have the need and you don't have the capacity. So again, we shouldn't be taking that risk because we simply don't need it. We don't have the capacity for it. So use that mnemonic. Can I take the risk? Do I have the capacity for the risk? Do I have the attitude for the risk? And do I have the need for risk? And don't forget the number one rule here. Don't risk money that you can't afford to lose. What's the money that you can't afford to lose during your retirement? It's the funds that you rely on to take care of those basic living expenses. I often use the risk triangle to describe the two different types of investments. There's either money that's at risk or money that's safe. Why do we have 3 points on that triangle? Why do we put money in safe places? Because in the bottom, on that safe money, we either need it for emergencies in healthcare, or we need it to take care of our basic living expenses, and we can take risk with the remaining dollars. But don't take risk with money you can't afford to lose. Lee, back to you.
Well, if you are one of those people who have reached your uncle point, maybe you're tired of trying to do it yourself, you're not really sure what's out there for you in your retirement, it's an opportunity that we have in front of you today. I hope you'll take advantage of. For the next 10 people who call us right now, we're offering a complimentary review of your entire financial and retirement plan. It's an opportunity to get an education about your money so that you can make the very best decisions possible for yourself and for your family going forward. So for the next 10 callers, Casey and the team and Howard Bailey will make some time on the calendar to visit with you and give you your very own purpose-based retirement. Casey, I want to bounce back for a second to that conversation about risk with clients. Tell me one of the most surprising answers that you've heard when you ask somebody about their risk tolerance.
Yeah. You know, I've got a client that's 75 years old, and when he came in to meet with me, we ended up implementing this plan, and I asked him about his risk tolerance. Are you comfortable with risk? Do you remember 2008? Is what I so often answer, or so often ask. I said, well, what was 2008 like? What was it like going through that period of time in your life? And he said, well, it was an opportunity. You know, the market lost a substantial amount of dollars during that period of time, and his portfolio lost about half of its value. He said, it's back. And it didn't cause me any angst. And to take it a step further, I said, well, what about your real estate? Because he actually owned a substantial amount of real estate during that period of time. That's how he made most of his life savings, was created in rental properties. And I said, well, how did it make you feel when those rental properties lost about half their value? And they all did. They all lost about half of their value. His net worth was cut in half. And that is a lot of money to just be gone overnight. Sure. And he said that didn't concern me because what I had was income. He said all those different rental properties that I had were all paying me basically dividends, right? They were all paying him income, and when they went down in value, he had been taking that income and he'd been setting a lot of it in cash. When those properties went down in value, all the other properties went down in value. He went out and he bought more very cheaply, and he watched the properties come back in value, and he continued to collect his income. And I think the lesson that can be learned from that is that we need to have a portfolio that's being actively managed if we're going to take risk, that's generating a nice dividend, that you have a team that's taking that cash and going out and buying when opportunities come along in the future.
We hope that you'll be one of those wise investors, and the first step to being there is watching the Purpose-Based Retirement each week. You can also visit us online anytime you like at howardbailey.com. We'll see you next week. Take good care of yourselves.